Thanks everyone for joining. We're excited to we're going to be diving into PPLI with Rajiv, but we're going to give people another minute or two to join us. So if you can hear us, please let us know where you're joining from. Rajiv, where are you joining from?
I am from San Diego, sunny San Diego, where it's October and 78 degrees.
Ooh, that is, it's funny. So I'm in New York, and I'm going to cheat here. It is sunny in New York, and it is 69 degrees.
Okay, that's not bad. That's not bad
Yeah,
for
I know.
October. Yeah.
This is I moved to New York late last year.
Oh, you did?
Said winters have gotten milder, and that is, I don't know if that's true, but it's definitely starting later. So that's.
So what was the draw to move to New York? The city life?
My wife's starting residency.
Oh, okay. All right. Well.
So that was what brought us here. But we'll give people another minute and then get into it. All right, perfect. Let's get started. And so I guess to start with, Rajiv, do you want to kind of just give a brief introduction on kind of your background? This is, I think, obviously going to be pertinent to why you are why it's valuable to hear from you on PPLI, just your background, what you did in the past, what you do now, and then we can go from there.
Yeah, thanks. Yeah, so I'm an actuary by training. I actually worked for New York Life, basically pricing their UL and VUL products and looking at lapse and mortality. And basically now I use my expertise to educate people. How do we use life insurance as financial planning tools, right? So, the analogy I used to like to use is basically I was traded to the opposite side of the team, right? So instead of making these products profitable for insurance companies, I work with high net worth individuals, estate attorneys, investment advisors to educate them. Basically, how do we use this as a financial planning tool as part of a holistic plan?
Yeah, and this is, one of the things that's exciting is you've seen both sides of the table.
I've seen both sides. Yeah, I understand.
You understand what people are solving for. You understand what insurance companies are solving for.
Correct.
What is the value to individuals? And really kind of, to the point of trading to the other side of the table is what should the individual be solving for versus, and I'd say in most cases, in this case, it's fairly aligned between insurance companies here and, high quality insurance companies and individuals, but there are nuances depending on what you're solving for. And just to give kind of just a brief overview. So Valur, what we want to do is we want to help people understand what are the best practice tax mitigation tools out there. And so just give my brief background. I worked for a startup, and I was fortunate the startup did well, was IPOing. I didn't live in sunny San Diego, but I lived in San Francisco, where it's always foggy, but still has the same tax rate. Yeah. And when this exit was happening, I was trying to figure out, how do I maximize my exit? I'm sure everyone here has heard stories about how billionaires legally avoid taxes. My thesis was, if they do it, why can't I? And at that time, naively assumed, hey, this is somewhat straightforward. Of course, everyone's going to take advantage of this. Much like anything, whenever you're building a business, you quickly realize the world isn't efficient. And so, this was me talking to friends to, on 9-figure exits, realizing, hey, they didn't do anything, or they did these things that aren't the best option. Chatting with attorneys and accountants, and you realize there's a huge volatility of quality of what they do. They make mistakes. And kind of the broad thesis of Valur is, how do we use technology, one, to help people understand what are these best practice tax mitigation tools, and really understand what are the quantitative as well as qualitative benefits and trade-offs. And like a key part here is, one surprising thing about this industry is, despite taxes being very financial, historically much of this information is very qualitative, which is kind of a huge, for me at least, didn't really make sense, because if you're doing, no one does taxes for fun. There's a few, weird people like Rajiv and I who enjoy these things, but most people, you do it because you want a financial benefit. And so I think like a strong grounding that we believed in is, how do you start with what is a financial benefit to really help people decide, is this worthwhile or not, to spend time to get into these other areas. So at Valur, we help people understand what are these best practice structures, the benefits, trade-offs, and then we help people implement and administer these structures. We've automated a lot of this to make it a better experience, lower cost, and more optimized on a setup as well as ongoing basis. So today we're really going to dive into private placement life insurance. Private placement life insurance, you may have heard it. It's also known as PPLI. It's a very kind of unique structure. Some people call it a super Roth. It is a way to kind of, in a weird way, avoid all taxes for things. It's typically a big part of estate planning. So we're going to go through kind of what is holistic estate planning, how does the pros and cons of estate planning, what PPLI really is and why it's growing in popularity, and then just how you can use PPLI to create more wealth, dive into some numbers. Again, we believe all these should be grounded in numbers, and go into Q&A. The one thing I want to call it is please let us know if you have questions. So if you have, put them in the chat. We'll either address them in real time or when it makes sense. But we want to make sure this is tailored to what's most helpful for everyone here. So let's start with kind of like, what is holistic estate planning? And, I don't know, Rajiv, if you want to jump in, like there tends to be three categories, right? Most people think about category one of
just focus
what do you invest in? Yeah. And this is, you hear categories of private equity, public stocks, bonds, private credit. All those are different asset classes that have different risk return profiles. And that's traditional kind of investment management of how do you allocate, how do you get diversification? Then there's a piece of how do you minimize the taxes on those things? As private credit has a different tax liability than bonds, which has a different tax liability than public stocks. And so there's, in some case, we're all looking for what is our post-tax adjusted risk adjusted return. And there's things you think about asset location of, you may put more, we call them tax inefficient investments, things that have a higher tax rate, into more tax advantaged structures, or the placement or what owns them and your allocation as part of income tax planning. And then estate planning is, do you want to jump into kind of what estate planning is, Rajiv?
Yeah. I think estate planning is essentially focusing on generational wealth, right? For the high end clients, obviously for the average client, it's more just, wills and trusts. But for the high end client, it's like, how do I create generational wealth in order to protect the wealth that I've created during my lifetime from being taxed, so that my beneficiaries get the most out of it.
Yeah, exactly. And really and the reason that we separate income tax planning and estate tax planning is they're two different taxes.
Correct.
Right. So it's income tax planning. This is what people are most familiar with. It's your ordinary income taxes and capital gain taxes. Estate tax planning is, the two taxes are the gift and estate tax, which is actually kind of one tax, and then the generation skipping tax. And this is really if you're planning on passing on more than, this year's $14 million if you're single, 28 if you're million if you're married. Next year it's 15 and 30 million. Above that, you face a 40% tax on both of those. And so estate planning is, how do you minimize that? To really, the way I break it down is, income tax planning is, how do you maximize what you and your spouse keep after taxes to use during your lifetime? Estate planning is, how do you maximize what your kids, grandkids, and future heirs receive after those taxes? So,
and I want to add, I think the importance of this slide is understanding the whole, how all these three different parts combine, and the importance of a mind shift, right? Like, especially if you're equity owners, you've made a lot of money from your own company. At first, you're focused just on investment management, on the equity return of your own company. But as you do well in your particular field, you start thinking about, what about the income taxes? But it's understanding, like, as I diversify, as I look for more, how do these interact with each other, right? If I'm getting a high return on investment, but I'm getting hit with a huge amount of taxes, is that risk really worth it? And the same thing from an estate planning side. So I think, as we kind of go on in this presentation, understanding the importance of what we'll be showing you is using the tools in the tax code that are available to you in the most efficient way to create a generational wealth type platform for you and your family, as opposed to just focus on the one element that perhaps got you here. So understanding the steps going forward for generational wealth are going to look different than what might have gotten you to this point.
Yeah. And so let's talk about, we'll briefly talk about estate planning. So, at one level, the big advantage of estate planning is, again, maximize what your kids or grandkids and future generations receive. And so it's the key kind of things here are, we're not going to go too deep because estate planning is its own topic area. But like, the reason you want to do this is you want to minimize those taxes by, if you get 15 million today and it's worth 30 million next year or 5 years from now, the advantage of gifting it earlier is that you avoid taxes on that 30 million, because all the appreciation that happens after you get 15 million today doesn't count towards your estate tax. So that's kind of a core reason to do this, to gift these things. Now, there's obviously some kind of risks of estate planning. Is one, it's much simpler. If you just own assets in your name, what this is in your normal bank account, you have more control, more flexibility. So you're adding complexity when you add a trust. Now, the benefits, there's no free lunch, and
Correct.
Almost every wealthy family decides this is worth it if they want to pass those assets on. So if we talk about return risk, like it's it's very weighted towards it's worth doing, but there are downsides. You're adding complexity. Yeah, exactly. You're putting this out of sight of your direct control. You still have indirect control and potentially indirect access, but those are kind of key pieces there. Now, all these things we call it complexity, cost. Every wealthy family that wants to do this decides this is worth it, which is probably some indication. Part of what we also do is make those things easier, but you're creating a legal agreement that adds some inflexibility in terms of what you can do, what you can gift. You'll typically set this for all your future heirs' benefit. But what that means is that limits that it is for them, and you may limit of how much they can pull out per year. We're setting rules that are supposed to last forever, and so that's a good and bad thing. And so we say it's inflexible, but that can be good and bad there. Any big benefits or risks that you think are worth calling out, Rajiv?
Yeah, I want to emphasize, like, to pull in the importance of the last slide, like thinking about this holistically and going forward. We talked about like when you generate wealth, that's one mindset. But going forward, it's how am I using the tax code, what's available to protect going forward? It is a different fundamental mindset. You're no longer wanting to chase after return, right? If you made $100 million
it's part you're doing you're solving for your return after taxes, right? And so it's a combination of these things. It's not just top line. This is like any business.
It's not more that top line got you here. It's like, well, there's different tools available for me to protect my wealth, right? And how much do I want to use these tools, right? There is complexity, but the reason what Manny was talking about earlier is it's worth it because the value proposition, the optionality that I have to protect my wealth, what the tax code provides to protect my wealth when I have $100 million is not the same when I have 50,000, right? So it's how am I using these tools? And I think that's why the optionality of what these tools provide is worth the complexity.
Yeah, agreed. And this is 100%. And this is the one thing I want to call out is when we say tools, we're often talking about structures. There are legal structures, financial structures.
Correct.
And what I want to it's important to call out is the structures you use for income tax planning versus state tax planning are different. They're typically trusts or these, in some cases, insurance structures or other things. But each of these things have different attributes, and they're constrained in what they can and can't do. And so they're optimized for different things. And so this is where today we're obviously very focused on estate tax planning, and PPLI. But typically these things depending on what you're solving for, that limits which structures you're focused on. And then within that, there's, I'd say there's probably 5 or so structures within estate tax planning that are kind of go-to things. PPLI is one of those, but they all have different attributes. So,
and I will say part of what we're talking about here in this presentation is like, how do we stack estate planning opportunities? How do we stack planning opportunities? I don't want to go into the wealth of things available, but there's so many tools when you stack it, it solves for all of it. And that's why this little, Venn diagram in the middle is like, you can 100%. Do everything you want to do. It takes proactive planning. You have to be an active participant in the planning, which is the generational wealth type mindset, which is going to be different than, let me create that wealth in the first place.
Yeah. So let's get into so private placement is one of the kind of just hottest products around. But let's start with the basics of what is private placement life insurance. And I'd also be curious from your background, you've been doing insurance for a long time from the actuarial side. Have you seen the change and kind of interest in PPLI?
Yeah, a lot, because I think, alternative investments, have, especially with the advent of the internet and technology, it's become more understood and available, right, through different platforms. And as part of the conversation of alternative and diversifying my portfolio, right, like, again, if I had a concentrated position, made a lot of wealth, how do I diversify? That became more public and more available to the average or high-end consumer. And so the reason it became popular is because, well, there's going to be tax consequences to certain alternative investments and tax inefficient. And the idea of okay, well, how do I, how can I access this? Here's investments I already invest in, but I want it to be more tax efficient. That conversation started coming up more and more from both the client side as well as fund managers. Fund managers would come and be like, is there a way to take my existing structure and make it more tax efficient? So that's when we talk about popularity. It's the word is, 10 years ago, very few people knew what PPLI was. It was always there. It's one of those esoteric parts of the tax code. It was always there, but very few people understood. But now, again, with technology and the everybody learning more, right? It became, people are asking more questions, and that's kind of where the popularity came from.
Yeah, and I mean, I think the other thing I've seen is there's the internet's obviously made it easier for people to understand. So this is kind of one of the things we believe in at Valur is just how do you make this information more accessible? I think we've also structurally seen more people, the providers of this, drop costs and make it more accessible. This is broadly, you see this in finance of everything becomes more accessible over time. Costs drop, minimums drop. And we've seen that where, maybe let's start with kind of like, what is PPLI? And maybe we can talk about 5 years ago, what would you see the minimum, or 5 or 10 years ago, the minimum to enter into PPLI versus what we see today?
Yeah, so I mean, 5 to 10 years ago, you were looking at people who only was 5 to 10 million and up, and it's above that. Now it's about 2 mil, for clients, and again to access the vehicle, right? And cost, the great thing about PPLI is again, traditional retail life insurance is based for the average consumer market, right? But there's a lot of cost involved in sales and marketing that gets embedded in that, borne by the consumer. With PPLI, what they do is they rip out a lot of the expenses, and the value of that doing is that, okay, it's, if we can get a lot of assets in this vehicle, again, $2 million into a vehicle is significantly higher than the average life insurance policy for the retail client, right? So you can drop expenses if you have that asset base. So that's the idea of PPLI. It's really for qualified purchasers, or people, with a lot of wealth, who are putting, they're not just putting the 2 million. The average, into a PPLI vehicle is closer to 7 or 8 mil that they're putting into this vehicle. And so on that basis, right, you can, the expenses don't need to be as high as for a retail investor.
Yeah, exactly. Now let's start with kind of just so what is the big benefit of PPLI? Why would someone choose to do PPLI? And, there's an insurance part. Are people buying PPLI, private placement life insurance, for insurance?
No. So this is, again, one of the tax code things, the same way, estate planning, it's like, okay, how do we use the existing, this is part of lobbyist and retail, what was put into the tax code as a way for wealthy people to not pay taxes. There's a lot, this is just one of them. And so people, the Congress is, okay, well, in order to do this, you need a minimum amount of insurance so that it qualifies, right? Back in the 80s, people would put millions of dollars and have $100,000 worth of life insurance. It's relative to $20 million in the vehicle. So laws came about to make sure that there is some minimum, but the way people are looking at this is okay, well, I want to earn a high return, right? And that would otherwise be tax inefficient, right? I'm going to get killed, especially if I'm California, 50% up on on whatever. So if I make 10%, I'm losing 50% of that, right? So what if I could put that in a tax-free wrapper? And so that's kind of where the genesis of PPLI kind of came about, is because people wanted access to tax inefficient.
And can I just jump in there? So I think just one thing that I'm not sure if everyone understands this, but so, most people, again, you're probably not going to be familiar with private placement life insurance. You may be more familiar with term life insurance or whole life insurance. Now, the interesting kind of nuance here is the reasons you're doing that is truly for the insurance. If you get hit by a bus, your family gets a payout, right? And the difference is how long is that period where you die so that your family can benefit. An interesting thing is investments inside of insurance vehicles are tax-free. There's no tax. They're not taxed on their growth. And so it's interesting, this is because historically this was for a different purpose, to take care of families. Now, again, there's the wealthy families, lawyers, they're very good at understanding what are opportunities in the tax code. Now, the historic downside of this is when people get term or whole life insurance, you worked at New York insurance, there'd be 1 million or 10 million people that are buying insurance from the company, and the insurance company, they want to aim for very stable growth. So they may be targeting 4 or 5% growth. And
correct.
So
it's a fixed income. All they're doing is they're investing in bonds, long-term bonds, and they're making that tax-free. So that's the value of whole life, as a financial planning tool. But what PPLI, it allows you to invest in more riskier assets, right? Which are also higher returning, and they put that within a tax-free vehicle. So that's the difference between the two. Fixed income is the whole life, riskier, assets are PPLI.
Yeah, and I'll just add the big difference here is with private placement, it's not only the insurance company isn't managing this. So the insurance company, if they're aiming for 5% growth, that's tax-free, that's fine. But if you're just getting the S&P returns, it's not that advantageous to it, right? Even with the tax benefits. PPLI is saying, one, let's allocate these to more aggressive investments, private credit, private equity, or just higher growth. And so obviously if those grow tax-free,
correct,
that is much more beneficial. And then the second critical insight here is private placement life insurance, this is not legally true, but private placement life insurance is insurance in effectively legal name only, where the minimum that of what you put into this policy that has to be allocated to insurance is allocated to insurance. The rest is being invested. So in other ways to frame this, and correct me where I'm going wrong here, Rajiv, is the minimum amount that you can allocate towards insurance so that your investments grow tax-free is what's happening here.
Yeah, it's just a tax code play. It's like, if you're a real estate professional, like, what do you need to do to qualify for this? It's the same idea here. Is like, what do you have to do to qualify? And I want to emphasize the importance of the tax code. Like, you have to comply with it. And so the thing is, you comply with it, doing whatever the law says you have to do, you comply. But it's so low relative to the value proposition here.
Yeah, and so this is where it's like, so then people are like, okay, so I don't pay taxes. What is the cost of this? Really,
Absolutely.
whether it's the VIG or the expenses.
Exactly.
Instead of the federal and, we both used to pay the Franchise Revenue Board in California, your taxing authority is now the insurance company.
Absolutely.
And so this is where it's like, let's call it, typically the expenses on that is 50 to 80 bips or 0.5 to 0.8% of the assets, which is going to be significantly lower than your tax rate. And so there is a quote unquote tax, but it's significantly smaller. Do you want to kind of jump into kind of like how to compare those things of what it is?
Yeah. I'm gonna try to stay high level without getting the nitty gritty of the expenses, but basically, to compare that, let's say you're aiming for a 10% return, right?
Yep.
So let's say you're invested in something like private credit, right, which is going to get taxed at 50%. So if you keep that in a taxable account, your after tax return is 5%. Right? With PPLI, let's say that's 80 bips, like the higher the number that Manny had talked about. So that's 8%. So I'm losing 8% of that return versus 50%. And so that's the value, right? Like, and you can do the numbers that you can change it depending on the return. You lower the return, and we can do that. But that's essentially the value of the vehicle, right? It's understanding what is the taxable status of what I want to invest in, and what is the growth rate? And it's again, simple math you can do there to compare, and the value compounded over time, right? The value of 10% compounded or over time is going to be significantly higher than 5% compounded, right? So you're reducing the volatility of that drag, and we can see that we'll see that in part at the end of this presentation. But I think people don't realize that the impact of like just smart financial planning, just smart being very proactive, and I want to emphasize proactive too. A lot of people, there's a lot of cool things you can do before, you exit a company and you're planning what Manny was talking about when he had his exit. After, you can still do cool things, but not as much as you can before. So the earlier you start your planning and thinking about these things, the better it is for not only you, but your family, your beneficiaries, your grandchildren, your great grandchildren who you won't even meet.
Yeah. Yeah. I mean, and by the way, there's two very interesting concepts. One is, no matter how smart and financially smart someone is, you're going to always undervalue the value of compounding. And so this means if you can cut your tax by 20% or reduce it by 60%, 70% of, instead of paying the federal and state government, you're just paying the insurance company, and that reduces your tax by 80%. Over a long period of time, the longer you do this, the more valuable it is. Like this is just, doesn't matter what how that plays out.
And I'll use this, super Roth, because it's easier for people to grasp. Like, if you've done any kind of retirement planning, a Roth is a tax-free account. Like, but the value of compounding within that vehicle. So if you think about PPLI in a similar light, it's a compounding vehicle. You want to keep the vehicle to compound as much as possible, and that's essentially what we're doing. We're just combining that with the rest of your estate planning to make sure and your investment planning to make sure everything kind of makes the most sense for you.
Yeah. Now let's we'll just briefly walk through. It's like, how does this work? So a client, let's say I want to move forward with PPLI, right? I am taking X dollars, and you're contributing cash. You're contributing cash towards a life insurance policy, right?
Correct. So the cash is first going to a life insurance company, right? They're deducting, life insurance expenses, but then everything else, we talked about the 10% to 15% of expense. So of your return, rather. And then what's left over is given essentially to your investment advisor. You are choosing who you want to invest your assets. So it's a separately managed account. The insurance company themselves is not saying, hey, I'm going to manage the money for you. They're saying, like, you choose the investment advisor. We're going to give it to that investment advisor, and we're going to invest in underlying investments. And then what happens is that, when that comes back, that's tax-free, right? So we have the arrows going in on the, to the right, are basically to the PPLI company, to your investment advisor, and then the underlying investments. And then they're coming back when you get the return, right? the otherwise taxable return is being made tax-free because it's abiding by the tax code and going through the PPLI company. So it's just a wrapper. The way, just think of it as a wrapper, like a Roth IRA. It's a similar concept.
Yeah, it's a wrapper where there's a small percentage that's going towards insurance.
Yeah.
The primary use case is actually tax-free investment growth. One other critical part I call it is there's ways that, so you can, let's just say you put $5 million or $2 million into a PPLI policy. You can get that $2 million, and let's say, again, let's keep going with me. I'm setting up PPLI. I can get that $2 million back to me, and then growth above that could be loaned back to me. That
Correct.
can happen,
Correct.
but that's not the goal of PPLI. Typically, you'll use PPLI, and it's for your heirs, grandchildren, and your phrasing of your future heirs that you haven't even met or you may never meet. It's for them to use more so than you. Yeah. Now, that being said, there is the break in case of emergency scenario where you can get some money, but that's not the core use case. But there is some optionality and flexibility there to get something back.
Yeah. No, I'll take it a step further. There's a lot of optionality. There is a lot of optionality so if you want to access to your money, you absolutely have it available for you or your beneficiaries. It just, again, it's the growth, and I'm missing the compounding. So just that play, how much do you want the money, and again, so we can talk about that later without getting the details.
Let's jump into kind of like what are some key things to consider here.
Okay, so just high level, you need to invest about $2 million into the PPLI vehicle. We talked about like how they're ripping out a lot of the expenses, so as part of the ripping out, right? Like you need a certain asset to come in to compensate. Must have a net worth of $5 million outside of your primary residence. Ideally, you're worth 15 million plus, right? Because if you think about, if you're only worth 5 million, they're not going to let you put 2 million of that into the vehicle, right? You're not going to qualify. Yeah. You must give up control and select an investment advisor to choose the investments. So what that means is that you can't go individually trade, right? If you have a self-directed Roth, you can kind of make individual trades on yourself. You have to have, when I say an investment advisor, it doesn't need to be a wealth advisor. It has to be, for example, let's say you want to invest in Bain Capital's fund. You can be like, okay, like Bain Capital, you're going to invest. I'm just not going to choose your trades. But so if you have fund managers you like to see if they're on the platform, the investment advisor must meet diversification requirements. So that's 5 different positions. So
and there's just one question here. So Alfred had a question of like, what are the different investment options? So you can't put everything in one thing, but what are the different types of investments? When it says 5 different, what does that mean? Does it mean I just can't own a whole 100% Apple? Could I own 100%?
Yeah, you can't. You can't own. So imagine, kind of like, to simplify it, like 5 different stock positions, right? Like you can't put 100% in Apple. So your investment advisor would have to at least have 5 different stocks, right? Yeah. So it's 55% in one, 70% in two, 80% in three, 40 or 90% in 4. So in total, you need 5, right, to compensate. So an insurance dedicated fund is something like a fund manager will set up. And the reason they'll do that is to avoid this limit. Like, let's say I have a great strategy, but you can only allocate 55% to my strategy to meet the diversification. I can set up what's called an insurance dedicated fund. Then you, the client, can allocate 100% of your money to my strategy. So if I'm a fund manager, I want to set up an insurance dedicated fund so that all my clients can put all of their money, their 2 million. I don't want 50% of their 2 million. I want the whole thing, right? So that's what insurance dedicated fund. And there's options on the platform. If you're interested, you can email me. We can talk about that later. But basically that's the idea. If you have a wealth advisor, they can be your investment advisor. They'll just have to choose their strategy. There are 5 different positions. If you want to, choose your own investment advisor on the platform, you can do that. And so that way you're not having to go through the wealth advisor. So that's essentially what the options are available.
Yeah. This other one, and this is where it's like, the higher, or this is another way to state this is like, so the higher earning and more tax inefficient an investment option is, the better it is for PPLI.
100%.
And so just to break this down, I'm going to use round numbers here. Let's say investing in the S&P gets you 10% a year. We'll assume that's going to be long-term capital gain. So, if you're in Texas, that's closer to like 24% tax rate. Right. If you're in, if you're fortunate to be in San Diego, you're going to be closer to 35%. Now, let's say you're investing in private credit, and that's private credit's targeting, let's call it 12% a year, but it's all short-term and it's ordinary income. Correct. So in, Texas, you're paying 37%, and in California, you're paying 50%. So if you look at private credit after taxes, you're not getting 12%, you're getting 6%.
Correct.
if it's in a taxable account. And let's just assume, on the S&P, if you're paying it every year, in California, you're getting 10% pre-tax, 6.5% after tax, right? And in Texas, it's closer to, on the S&P, 7.5% after taxes on the S&P. Now, but if that private credit is inside of PPLI, because there's no taxes, you're earning 12% pre-tax and post-tax,
Correct.
minus the insurance fee. So
let's call it 11. So I mean,
Yeah.
that 80, I'm just rounding up to make it. So now you're making 11% tax free,
Yeah.
right? Like, so relative to the taxes you're paying 11, because otherwise you're making 6, right? So it's like this math.
Yeah, and so this is where it's, when Rajiv is talking about holistic planning, there's, hey, you want to diversify between different asset classes, and that's something to work with your investment advisor. But then there's the asset location of these things of
100%.
This is obviously not a real scenario. Let's say you're doing 50% S&P, 50% private credit, and you had a PPLI and you had a taxable account. You want to keep the S&P in your taxable account
100%.
and the private credit in the PPLI. To this is gross oversimplification, but the idea of the more tax efficient it is, you want to put it in a more tax efficient vehicle to cancel out the negative tax externalities.
Yeah, and I'll say, to that original slide we showed, like I see a lot of people being like, okay, let me just put the whole portfolio, and like you can do that, of course, but you're not making them use of the vehicle as much, and as well as your estate planning is also not being considered. So like, just the importance of kind of considering this as you move forward.
Yeah. Let's jump to, there's a couple questions here. Can an investor with real estate or oil and gas portfolio utilize PPLI, or does this pertain to securities?
So you can. So there are fund managers that on the platform who do. There's plenty that do real estate. Millennium is one of the biggest ones. They have like $4 billion in a variety of real estate strategies. Now there are benefits. Now, before I get into real estate, there's depreciation deductions if you do individual. So I guess it's important to separate, like, okay, hey, am I investing in REITs or am I doing individual real estate, right? Because then there's a lot of things with depreciation recapture. So there's like math involved in if you're moving individual positions in, and you can do what's called in-kind contributions. So if you have a number of, let's say, properties or whatever you want to move in, you can do that, but then you're going to lose some of the depreciation benefits and recapture. And so you have to consider this in your planning.
Well, let's keep. So really, how can you? This is I think to the stacking piece, right?
Stacking, absolutely.
Yeah. So typically structures are geared towards one problem, right? And this is but there's ways that you can get more of or get multiple benefits from this. And this is where PPLI is one of these great examples of. It's typically not geared towards income tax liability because it's typically not for your use. There's a flexibility to get assets there, and it does decrease some of the benefits. But what you can do is you can take PPLI and have this tax-free wrapper, put it outside of your estate, and typically what's called an irrevocable life insurance trust. And the idea is then all the growth in this PPLI policy is outside of its estate tax-free. So it's estate tax planning. And then you're able to avoid estate taxes and income taxes. Now, it's not typically considered an income tax product because it's not typically for your use, but there are ways you can benefit it. And
yeah. So I think it's the stacking piece. So the estate planning vehicle is protecting the estate tax. The life insurance vehicle, in combination with the estate planning vehicle, does both. I will say I do have clients who use PPLI as well as other life insurance products because they want the tax-free growth, and even though they want it in their estate simply because they want more control and access, and obviously that's not the maximum use of it, right? But it's the flexibility and optionality. They're like, okay, well, I understand I'm going to pay an estate tax. I just like the wrapper, the tax-free wrapper. So
and this is where it's like PPLI is the investment wrapper, but then you'll typically you'll put it outside of your estate.
Absolutely, that's the maximum use. That's the best, But a lot of clients just want to have access, and they're like, okay, I just want this tax-free wrapper now,
So let's jump into kind of now. There's always the again, what does this financially mean? Okay, you're probably okay. I get it. I don't want to pay income taxes. I don't want to pay capital gain taxes. I get the value of avoiding estate taxes. This is just essentially instead of paying the federal and state government, I'm paying a smaller fee to the insurance company. That makes sense. So let's jump into this kind of case study of a couple has a business in California. It's generating $5 million a year. It's worth $30 million. They expect to sell it in 5 years for $60 million. After selling it, they expect to, fairly conservative. They expect to get 6 million. After, well, not conservative, I guess. After taxes, they get 6%, right?
Yeah.
Expectancy, they expect to live another 30 years and leave their assets to their kids. How do they, and really there's the solving for it's like, how do they maximize what they pass on after both income and estate taxes to their heirs, right?
Yeah. So basically, it's a planning opportunity. So you can move, part of this asset, which is the business, outside of your estate into estate planning vehicles, right? You set up an estate planning vehicle, you move it in. What's great about this, you can get a discounted valuation if done properly, structured properly on this asset to minimize the tax liability. And the other thing that people often miss is, like, let's say you have a business generating $5 million a year. What happens is that's all dropping down to ordinary income, right? But if I do this planning opportunity, like I'm moving it out of the estate, I'm freezing the estate tax liability, and then I'm solving for some of this income tax issue that I have. Not only now while I have the business, but after I sell, what's going to happen? I'm going to have a capital gains tax. But if I put an asset in now that it's at a low value, and it's going to increase in the future, right? Then the growth is going to be tax-free. I always use this example of Peter Thiel's $5 billion Roth IRA, because he put $2,000 in to purchase his PayPal shares, right? And then that when he sold PayPal, or PayPal got sold, that was all within a tax-free vehicle, and then he kept on and reinvesting, and that's how it ended up in to a $5 billion Roth IRA. But the idea is the same here: is that with preemptive and proactive planning, you're moving an asset that you expect to appreciate, right? You're protecting it from the income tax liability, so you're getting the compound growth. After that business is sold, you're continuing to invest, right? But that's still within the wrapper. So the value of the wrapper and being outside of your estate has tremendous value when combined. And so that's essentially the case study here.
Yeah, and let's jump into kind of like, what do these numbers mean? And this is one of those really kind of, we laid out three scenarios. Is one is you do nothing. So, hey, they keep the money in their estate. They pass away. When they pass away, they're paying income taxes. What they have after that passes on to their kids. So then it's exposed to income taxes, and all the growth happened in their estate.
Yeah.
All the growth happened inside their estate, and they pay estate taxes. Guess what? Unsurprisingly, that has the lowest. It's not a bad scenario where they're passing on 164 million. And I do want to caveat, a lot of what we're talking about is how do you get the highest, even without these things, you can put your family in a fine situation, your kids in a fine situation, but it's really how do you get the most out of this? But let's say they just do estate planning. They move these assets outside of their estate. In this case, they're still exposed to income taxes, capital gain taxes. So in this case, instead of passing on in 30 years 164 million, they're passing on 253 million. It's obviously pretty good. And it's nothing to complain about, and significantly better than doing nothing. But then let's say you use PPLI, and really what you're able to do is you're able to avoid the income taxes and estate taxes by passing it on. That's where, in this case, they're ending up with 678 million, because, we talked about they're getting 6% after taxes. They're actually earning in the PPLI, they're earning more.
Correct, because it's compounding. There's the lack of the value of compounding in a vehicle, and so I think that obviously numerically that's you can see the value of compounding. But I think more importantly, if we take a holistic element to it, it's like this is a tool, right? Like, and to understand what's available to you, and like Manny was saying, like whether you have 164, 253, or 60, that's still a lot of money. But it's what are the tools available for you as you kind of move forward, and what opportunities does this provide, and how are you using what's the tax code allows you to do? And I think that's the mind shift, not the number, right? Like, yeah, sure, it's a lot more money, but how are you setting up future generations, right? What values are you passing on by setting all this up?
Yeah, exactly. I think that's a great point. This is if you're fortunate to be in the stage where you're thinking, how do you set up future generations and maximize what you pass on? This is a great vehicle to do so, and it becomes even more powerful when you stack these things, right? Like, you have a separate question of how do you invest these assets, which you should work with your financial advisor if you're working with someone, or manage yourself. But then there's what tax advantage vehicles and wrappers do you use to get the most out of this? How do you maximize, there's different trusts for maximizing your gift and estate exemption. There's vehicles that get flexibility. This stacking the PPLI plus the life insurance trust stacks minimizing estate taxes plus income taxes, so that your heirs and future generations, they get to benefit from tax-free growth starting with a high base, and it ends up being, unsurprisingly, if your assets grow tax-free, they will end up a lot larger than if they grow after taxes. And so that's kind of really what this is calling out. I know there's some other kind of questions here. There's, can qualified funds can be used to fund a PPLI policy?
No, you can't, because those qualified funds are, on a pre-tax basis. You would have to exit that, and you can't use qualified funds. No.
Yeah, the broader thing I think to call out is you're using post-tax cash to fund PPLI.
Yeah,
right.
absolutely.
Like this is cash in your bank account. Like, you're not going to fund PPLI with your Apple shares or your private stock. You're going to fund it with cash. The policy can buy these different types of assets, but you fund the policy with cash, right?
Yeah, I mean, I think you can, like I was saying earlier, you can put your in-kind, private assets in, whether, I mean, real estate or it's more typical private shares in a company, you're moving that in. So you absolutely, that's not that is the most actually effective use, because that private asset is going to have, or you're expecting it to have large growth within the vehicle. But most typically it's cash, right? Most people fund it with post-tax cash.
That's kind of the piece there. And so it's kind of just like want to give people a couple minutes to ask any questions that they have it. Otherwise, big things up here of like, so if you have questions, if you want to learn more, you can set up time with us. You can reach out to Rajiv. We have both of our emails here. You can schedule. We have both of kind of our calendars. And so this is where I'd say if you're interested in learning about when does PPLI make sense, how it makes sense, you can book time. We both have kind of learning materials that we'll follow up and share after this email. We're going to send that out with the recording. So you'll be able to see that, and with these links, so you can book time as well. And hopefully you kind of understand of why PPLI 1 to start with is very powerful. And also, as it's become more accessible, why it is becoming more popular, because it's, if you're planning for heirs and you have enough money to fund this, and you don't need the money, I'd say in the immediate term, it's somewhat of a no-brainer. And so that's kind of what we hope has come across. And we can obviously go into more details, dive into your personal situation afterwards. So can give people another minute or so. But Rajiv, wanted to thank you for taking the time to join.
Yeah, absolutely. It's so fun. I always love talking about, like, look, it's esoteric, but to me it's fun, and it's interesting, it's exciting. There's a lot of math. And also just the planning element. I love the planning element of it. They're like, if you actually do proper planning, the value is tremendous. And also there's a psychological element, the mindset shift. And so that's an interesting component for me too. So this is always fun for me to talk about.
It feels very weird. It's fun. It's weird. It's a fun problem.
It's weird.
Also very weird to, you look at this and be like, hey, we can create $400 million of additional value over 30 years with this. And this isn't being Warren Buffett. This is just saying, hey, I'm going to structure this to pay less taxes.
That's the part I love. That's the absolute part. I'm really just structuring it, just financial planning. It's just like, I'm not taking extra risk, right? Like a front end risk, right? Like I'm just creating this from like extra smart, where else can you do this?
Yeah. How do you deliver Warren Buffett returns without having to get 20% returns per year?
Yeah, without taking investment, so it just being more, strategic.
One last question, which I'm going to kind of hopefully answer correctly here, is Stefan's calling out, can clients borrow against a policy? You can borrow, you can take a loan against the growth on the policy. So
you can get 90% of the value in. So if you put in 2 million and that goes to 20 mil, you can get about 18 mil out.
Yeah. Perfect. Appreciate everyone taking the time to join, and we'll hopefully see you in a couple of weeks at our next webinar.
All right. Take care, guys. Thank you.
Thanks, Rajiv.